The divine intervention once again take notice of Target and wants to learn more about their secrets and functions. With that, we will uncover Target's performance in relation to its external environment and rivalry. To start the industry analysis, we use Porter's 5 forces to assess how these factors influence the retail industry's overall attractiveness. For competitive rivalry, there are many competing formats, including online and physical stores, all targeting the same customers. Growth is also volatile due to the shifting consumer demand, and the presence of many established competitors increases pressure. Thus, this force has an assessment of strong. For the threat of new entrants, digital platforms lower entry barriers by reducing the needs for physical store. However, this is offset by strong economies of scale, efficient supply chain, and established brand trust, which makes it difficult for new players to compete effectively. This makes it moderate. For the bargaining power of suppliers, retailers depend on global suppliers and are affected by external factors like tariffs, which increase supplier influence. At the same time, retailers can diversify sourcing, which help limit supplier power. This is moderate. For the bargaining power of buyers, customers can easily switch between retailers, have access to many alternatives, and can compare prices instantly online. Their high price sensitivity put instant pressure on retailers to stay competitive. This is clearly strong. Lastly, the threat of substitutes. Consumers have access to alternative purchasing channels and may shift spending across different product categories. Although retailers offer a wide range of products, substitutes still pose a significant challenge. This is also strong. Overall, the retail industry is moderate in attractiveness, while strong forces like rivalry, buyer power, and substitutes create intense competition. Moderating factors such as economies of scale and supplier diversification help maintain stability in the industry. Moving on to PESTLE analysis. Politically, trade policies and tariffs can quickly disrupt supply chains and increase costs for retailers. This shift creates uncertainty in sourcing and pricing decisions. Economically, retail is directly affected by inflation, interest rates, and unemployment, all of which influence consumer spending power. At the same time, rising input costs and tariff changes continue to pressure profit margins. Socially, consumers are shifting towards online shopping and expect faster and more convenient experience across channels. Changing demographics and spending patterns also reshape product demand and store strategies. Technologically, the industry is increasingly driven by e-commerce and data systems that improve operations and decision-making. However, this comes with higher costs, complexity, and growing risk like cybersecurity threats and system dependence. Legally, retailers must continuously comply with evolving law labors, trade regulations, and strict data privacy rules where non-compliance can lead to penalties and reputational damage. Environmentally, supply chain disruptions caused by climate and environmental factors can delay operations and increase logistic costs, making resilience a critical concern. Overall, these forces show that retail is not only shaped by consumer demand, but also by a constant shifting external environment that requires continuous adaptation.
Moving to the strategic group maps, we can see how firms group together based on their business choices. The first map compares product line breadth and distribution channels. It highlights the difference between Costco, which is a limited selection of bulk items, and Amazon, which acts as a marketplace with nearly unlimited merchandise. Looking at distribution, we can differentiate Dollar General, which relies heavily on physical store numbers, from Walmart and Target, which have heavily integrated their physical stores to act as online fulfillment hubs. The second map looks at value positioning against geographic scope. While Walmart and Dollar General compete primarily for budget-conscious shoppers, Target separates itself by focusing on curated and trendy or design-focused merchandise rather than just the lowest price. Finally, geographic scope is a major differentiator here. While Walmart operates in 19 countries and Amazon has massive international centers, Target is based exclusively within the United States. While these maps illustrate the different positions each company occupies, their actual performance depends on meeting specific competitive requirements. Key success factors are the essential elements that determine a firm's ability to survive and stay profitable in this market. First is offering a strong selection and enticing private brands. This gives customers a reason to choose a specific store beyond just basic commodity items. Creating high-quality, exclusive labels such as Target's Good and Gather or Costco's Kirkland Signature builds loyalty because shoppers cannot find those exact items at rival stores. Next is competitive pricing through low-cost distribution. This means offering everyday low prices through highly efficient operations. Big retailers use their size to attract buyers with steady, cheap prices. To do this, companies must keep overhead low so the final shelf price beats the competition. Third is strategic omni-channel fulfillment. Using a large network of store locations allows for fast and cheap pick-up or home delivery. Success here means a customer can smoothly switch from browsing a mobile app to grabbing their order at a nearby neighborhood branch. In a changing retail environment, long-term survival hinges on the agility to pivot alongside technological shifts, specifically through the evolution of digital tools that keep customers engaged within the firm's ecosystem. It is vital for companies to adapt to the evolving shopping habits to maintain a competitive edge as consumer trends shift. Fifth is favorable brand image and customer loyalty. Winning firms sometimes use membership models like Costco or Sam's Club to foster intense customer loyalty and steady income. Keeping a good reputation ensures the business stays popular and valuable even as global rivalry increases. Consistently delivering on these 5 factors is what enables a company to build a defensible position against its rivals. For Target, mastering these 5 areas is vital for securing long-term growth and success.
Now we will proceed with the analysis of Target's rivals in terms of financial performance. Target's revenue increased modestly early in the period, however, it plateaued and slightly declined after 2022, reflected in a low CAGR of 2.29% and negative growth rates in the most recent years. In contrast, Walmart maintained steady growth, while Amazon grew aggressively with double-digit gains, indicating stronger market expansion and demand capture. From a cost perspective, Target's operating expenses grew at a controlled pace and even declined slightly in 2025, which may indicate cost management efforts. Meanwhile, Amazon's significantly higher expense growth aligns with its increased operational activities, while Walmart balances moderate expense growth with stable revenue gains. In terms of profitability, Target shows notable volatility, with a sharp earnings decline in 2022 and an overall negative earnings CAGR. This suggests margin pressure despite relatively controlled operating expense growth. Walmart demonstrates more consistent earnings improvement, while Amazon, although volatile, achieved significantly higher long-term earning growth, highlighting better scalability and recovery capability. In terms of assets, Target shows steady but modest growth, reflecting incremental expansion rather than aggressive investment. Walmart follows a similar pattern but is slightly more dynamic, with a temporary dip followed by growth. In contrast, Amazon's assets grow rapidly, indicating aggressive reinvestment in infrastructure and technology. Target sale productivity improved up to 2022 but has gradually declined since, indicating softening store efficiency despite a stable footprint. Walmart, in contrast, shows consistent gains year after year, suggesting strong execution in driving higher sales from existing stores. Amazon records a decline in sales per square foot, but this reflects its rapid expansion. Its expanding logistics network dilutes this metric. Target's retail space grows slowly and steadily. Walmart slightly reduced its footprint early on and then stabilized it, signaling a focus on optimizing existing stores rather than expanding aggressively. Meanwhile, Amazon rapidly increases its space, highlighting heavier investment in fulfillment and distribution capacity to support long-term growth. Now let us proceed to compare the financial ratios of the 3 companies. Target's current ratio remains close to 1, but slightly below it in most years, indicating limited short-term liquidity. It performs slightly better than Walmart, but is generally less stable than Amazon, which maintains stronger short-term coverage of liabilities. Target's quick ratio is consistently low, showing heavy reliance on inventory to meet short-term obligations. Walmart shows a similar pattern, while Amazon stands out with significantly higher quick ratios. Target demonstrates adequate ability to cover interest expenses, though it is less consistent than Walmart and significantly lower than Amazon in later years. Amazon's sharp improvement signals strong earnings relative to interest obligations. Target has the highest debt ratio among the 3, indicating greater reliance on debt financing. Walmart maintains moderate levels, while Amazon shows the lowest and declining debt ratio, reflecting stronger solvency. Target consistently records the highest liabilities ratio. meaning a larger portion of its assets is financed by liabilities. Walmart is slightly lower, while Amazon shows improvement over time with decreasing reliance on liabilities. Target has the highest financial leverage, confirming its greater dependence on debt and equity financing mix. Walmart remains stable at moderate levels, while Amazon's declining leverage indicates improving financial structure. Target maintains stable but modest profit margins, generally higher than Walmart but lower than Amazon in recent years. Amazon shows the most improvement, especially after recovering from a negative margin in 2022. Target consistently delivers strong ROE, higher than Walmart and competitive with Amazon. However, its higher leverage contributes to this performance, implying higher financial risk. Target's inventory turnover is stable but lower than both Walmart and Amazon, indicating slower inventory movement. Walmart and Amazon outperform maybe due to more efficient inventory management systems. Target shows solid asset utilization but is consistently outperformed by Walmart, which leads in efficiency. Amazon records the lowest asset turnover, reflecting inefficient asset utilization or underutilized capacity. Target's cash ROA fluctuates and trends slightly downward, showing weaker cash generation from assets compared to Amazon. Walmart remains relatively stable, while Amazon shows improvement in later years. Target's cash-to-income ratio is fairly stable, indicating consistent conversion of income into cash. Walmart shows similar stability, while Amazon experiences higher volatility but often stronger cash generation. The vertical analysis shows that as of 2025, Target has moderate cost efficiency, with a lower cost of sales than Walmart, but higher operating expenses reduce its overall margins. While Target's net margin slightly exceeds Walmart's, both are far behind Amazon. In terms of financial position, Target is more leveraged, with the highest proportion of liabilities and the lowest equity ratio among the three, indicating greater financial risk. It also shows tighter liquidity as current liabilities exceed current assets.
Now moving on to the value chain analysis of Target, Amazon, and Walmart. First, for inbound logistics, Target uses global sourcing offices and distribution centers to manage suppliers and ensure steady product flow. Amazon relies on massive fulfillment centers and FBA where sellers send inventory directly to Amazon warehouses. Walmart focuses on large-scale sourcing and uses systems like Retail Link to connect suppliers and monitor inventory in real time. Next, in operations, Target uses its stores as fulfillment hubs, supporting services like BOPIS, Drive Up, and same-day delivery. Amazon focuses on automation, robotics, and warehouse efficiency supported by AWS systems. Walmart also uses stores and fulfillment centers but uses AI and analytics to route orders to the most efficient location while expanding through Walmart Marketplace. For outbound logistics, Target uses stores and sortation centers plus shipped and third-party carriers to provide fast pick-up and delivery options. Amazon has a strong delivery system through Amazon Logistics, Flex, and Air, supporting prime fast delivery. Walmart benefits from one of the largest private trucking fleets using distribution centers and stores for delivery, pick-up, and shipping, including fulfillment services for sellers. In marketing and sales, Target is known for its cheap, chic positioning, exclusive brands, and strong loyalty programs like Target Circle. Amazon positions itself as a one-stop shop using personalization and Prime membership to increase loyalty. Walmart competes mainly through everyday low price, while you also using Walmart Plus and Walmart Connect for loyalty and advertising. After sales service, Target offers flexible return options including in-store and drive-up returns. Amazon is known for fast refunds and self-service online returns. Walmart also offers flexible returns and integrates customer service benefits with Walmart Plus. Now moving to support activities for firm infrastructure, Target focuses on omni-channel systems and sustainability programs. Amazon's infrastructure supports technology and logistics dominance through segments like AWS and advertising. Walmart focuses on cost control and long-term investments in automation and logistics. For human resource management, Target emphasizes employee well-being and development. Amazon focuses on scaling fulfillment labor and hiring tech talent. Walmart manages a massive workforce globally, focusing on operational training and customer service. In technology development, Target uses AI and RFID to improve forecasting and inventory accuracy. Amazon relies heavily on AI, robotics, and AWS innovation. Walmart also uses RFID and Walmart Global Tech to strengthen forecasting, personalization, and logistics automation. Lastly, for procurement, Target focuses on ethical sourcing and supporting private label brands. Amazon combines direct sourcing and marketplace sellers to increase variety and reduce risk. Walmart uses strong supplier relationships and purchasing power to support its low-cost strategy. For current strategies, we analyze Target, Amazon, and Walmart across corporate, business, and functional levels. At a corporate level, Target focuses on retail growth through strong own brands and sustainability initiatives like Target Forward. Amazon, on the other hand, follows a highly diversified strategy, expanding across e-commerce, cloud computing, and digital services, while Walmart focuses on retail expansion supported by its growing omnichannel and ecosystem services like Walmart Plus. At the business unit level, Target uses a differentiation strategy by offering stylish yet affordable products. Amazon applies a hybrid strategy combining low cost with convenience and innovation, while Walmart focuses on cost leadership through its everyday low price strategy. Lastly, at the functional level, Target emphasizes store-led fulfillment and customer experience. Amazon leads in advanced technology and automated logistics, and Walmart focuses on efficiency through its hybrid fulfillment system and large-scale supply chain.
Through this VRIO analysis, we identify Walmart as having one resource that provides it with a temporary competitive advantage, which is their RFID innovation, specifically for fresh food categories, that they pride themselves to be a first-to-market solution to transforming inventory processes. This resource was produced in collaboration with Avery Dennison, a digital identification solutions company in America. Other items, such as its designated technology arm, its ability to provide thorough seller support, and its having one of the largest private trucking fleets in the world, though are key to the business, remain closer to competitive parity. Amazon, on the other hand, has all of its key resources and capabilities at the level of competitive parity. Similar to our VRIO analysis of Target, this company's items, which highlight fulfillment capabilities, technological infrastructure, and its in-house outbound delivery network, are essential to the business as it continues to provide its service, but are common among players in the retail industry. This just simply means that whatever they can do, Walmart and Target are also capable of or are already doing it too. With its current strategies, Walmart still is the industry leader, following cost leadership when it comes to providing good products to its customers for low prices, while also maximizing its scope as it operates internationally, providing the company with yet another edge against competitors. Its technological developments, especially recent ones, provide them with a slight competitive advantage as they optimize their internal processes with one-of-a-kind solutions tailor-fit to their needs. And their financial position remains relatively stable as they experience steady growth in their revenue and expenses, which is also supported by the stability in most of their financial ratios. Amazon, on the other hand, is also a competitor that continues to make its mark in the industry, priding itself on having an extensive variety of products available for its customers, as it expands its reach to multiple geographic markets worldwide. Though operations and customer experience are relatively different, as Amazon operates online in comparison to the two other companies in this video that have physical retail stores. In the US e-commerce market, Amazon can be seen as performing well, but their financial position remains volatile as they experience changes in revenue and long-term growth. Expenses have also remained high for the company as they increase their operational activities and fund their expansions. And that's some divine intervention. Thank you for tuning in to yet another meaningful discussion with us. If you still want to join us as we look into Target, we'll see you on our next video.